How did you actually hear about the money multiplier? How did this all come to be?
Well, I was having a conversation with my brother one day, and he had mentioned that he was starting an insurance policy that was gonna, bring him good returns. And I was like, yeah. He's like, yeah, I seen the video. I seen the video. He finally sent it to me, and he referred me to the YouTube channel. And once I started watching, I was like, wow, I didn't even think anything like that existed.
And it's funny, it was a referral from your brother, and I hear this all the time. People see this, somebody sends it to them, they see a Facebook ad, and the first thing they always say is what you did. This can't be real. Like, there's no way this exists. That sounds too good to be true. I mean, was that what you thought?
Well, yeah. I mean, essentially, when it's beyond my shift, or something that I've never seen or heard before, you gotta kind of question it. But then, once you start diving in, you see, how these plans are beneficial and how people have been using them for years upon years. It kind of strikes like, okay, maybe there's something to this. Let's dive in a little deeper.
I remember, and I came from the financial world. I came from the insurance and the financial world. And I remember sitting in that cheesecake factory with Mike. And Mike was one of my private lenders who lent me money. And he's talking about this vehicle that he uses to lend money to me and to other people, and this vehicle that he uses for all of his real estate. And he starts explaining it to me. And instantly I'm like, Mike, dude, are you talking about a whole life insurance policy? He's like, yeah, that's what it is. And I'm like, whoa, all right, listen, like, they don't work that way. The way you just described it, that's not how they work. And he looks me dead in the eye. He looks at me and he says, if this isn't how they work, then how have I been lending you all this money on those deals? Because this is what I've been using, and it works exactly how I explained it. But I'm not the expert, so if you want to learn more about how and what it does, call this guy Brent, and he'll explain it, because he's the one that helped me. And that was how I heard about it. Now, how is it that I was an advisor at that point for 14 years at a high level, and I'd never heard about this? Which is the same reason why you were probably saying, how is it that I've never heard about this? But now the cat's out of the bag. It's not too good to be true. And when you dove into it, did you do some research? Did you do some background to figure out is this real?
I did. I started searching around. I started doing Google searches about different policies. I actually read a couple books, and when it got to the insurance policy part, I just kind of I don't want no insurance, and then I went back and I was like, that's what they were talking about. I was like, oh my god. It was such a slap in the face, because it was it was right there, but I missed it. I was like, no, it's short. I don't need that right now. It definitely was an eye opener once I realized the information that I bypassed. Wow.
It's interesting that you said that, because every person I speak to, we speak to thousands of people, but everyone I speak to, they say the same thing. I don't want a life insurance policy. What does this life insurance policy have to do with me building my wealth? But that's just because everything we've been taught in our lives has been against this. You hear the gurus saying, oh, whole life's the worst place you can put your money. Whole life's the worst investment. And I always tell people, I say, you know what? Whole life is the worst investment, because it's not an investment at all. It's a guaranteed place to put your money. And the other thing, too, that's funny about all the people that are out there saying, kind of what you did, where I don't want any whole life, is now that you know what it is and how it can work, you understand. But prior to that, you had this misconception of what a whole life policy can actually do. Because when you think of whole life, you think this is money for somebody else when I die, not money for me while I'm living. And the one thing that the money multiplier does, and the infinite banking concept does, is it literally takes a vehicle that most people think is one of the worst places to put money, and it uses it in a completely different way than anyone's ever been taught to use it, which is kind of what we're going to dive into today. And, I really want to spend some time learning about what your goals are, what are some of your money problems. We talk about money consciousness a lot, but we also talk a lot about what is the money problem. So let's dive right in. Like what I'm going to do is, as you kind of tell me your different things that you've got going on in your life, I'm just going to basically take some notes and I'm going to write them down and understand a little bit more about what you're trying to do and see if this system, the money multiplier, will solve your problems and solve your goals. Sound good? All right. Well, let's start with what would be the main objective? Like, what is the main thing? When you saw that video, when you saw the video the first time and you got done with it, you probably had like an aha moment, but you had lots of questions, right?
Yeah.
So what was one of the biggest questions you had after you watched the video?
How do I get this started, and who do I talk to get it started?
How do I get this started? All right, perfect. Well, yeah, that's great. I mean, because it was moving. I remember when I first saw it, I thought the same thing. I'm like, oh my God, I couldn't even wait. I almost didn't even get through the whole video. I'm like, all right, who do I call? Where do I call? What do I do? And same idea. But what would be the main objective? Like, what do you want this system to do for you?
All right. So when I originally started, the whole investment, part of my life, I started a business. I invested in one of the real estate, companies. I spent the initial investment. I started an LLC. I started playing the market, but I didn't have any capital, and I was in debt. So it was like, all right, I was in more debt because of the initial investment. And I said, you know what, one thing at a time. I had all these coaches calling me at one time. Coach for this, for the business, a coach for the marketing, a coach for this, that, and the third. And it was just too much to handle with my regular 9 to 5, of course, with all the debt, piling up. So I said, let me clear my debt. And I was successful in doing that. Then I picked back up to the business, to my business, CTU Homes. And I noticed that once I paid off my debt, my credit score dropped. And I'm like, well, they said that I don't have any outstanding debt anymore. I'm like, isn't that something? So then I started acquiring debt in order to fund my real estate venture, my business. And in the interim, I came across the infinite banking system. I said, you know what? Instead of that capital going straight to the business, to the asset, let me pay myself first and then pay it out from there. So it was just like one of those aha moments where I'm, I saved all this money up. I'm raising capital, and I'm trying to do like a big shift here. So now I want to shift into the investment portion of my business. And that's acquiring assets, of course, but paying off my debt first.
So basically, when you saw the video, you saw and found what looked to be a better way to pay off your debt. So you had got into real estate through this education program, and I did the same thing. I remember, I'll never forget that 3-day seminar in 2014. Same thing, right? You look at you laugh. You sit down there and you're like, all right, what are they going to sell me? Sure enough, they sell you something, and then you're like, okay, well, that first investment, mine was $24,000. And then after that first 24, you're like, all right, this is going to give me everything I need. Nope, then you got the mentors, then you got the coaches, and you got everything else, and it's just swipe the card. Sound familiar?
Yeah, it was bad. I was like, yeah, this wasn't the smartest move, with where I was at. But I made the commitment, and I haven't given up that drive. I haven't given up that goal of making passive income. So that's pretty much the ultimate goal: passive income, replace the 9 to 5, and just be able to live off passive income.
All right. So let's start with the initial goal, which is basically we want to essentially let's pay off debt, because that's the first thing. We've got some debt from the business, from the real estate that we've acquired. So the first thing I want to do is I want to really focus on that goal, paying off debt. All right, so we're going to pay off debt, but tell me a little bit more. What do you do right now? What do you do for a living?
I work for an electric company. I work as an overhead troubleshooter. So I've been doing that for I've been working at the company for 15 years. But it's one of those things where you don't want to do it forever, and that's why I got involved with real estate and trying to supplement that income to just kind of get out of that field.
So do you want to get out of the field because it's dangerous, or just because you're looking to add additional income onto what you're doing? Like, what's the end goal for you?
Well, I love what I do. I recognize it is a dangerous field, but I know that eventually, when I get into my older ages, I won't be able to sustain it. So eventually, yes, I want to supplement the exact income that I'm receiving at that point, and just be able to say, you know what, I know when my time's up.
Fantastic. Well, let's dive into the debt, since that's one of the biggest goals that we want to solve here. So tell me a little bit about your debt structure. Like, what debts do we want to pay off here?
Okay, so the main one is the 401k. The 401k loan that I took out. That was a consolidation of my student loan debt. So I went through several videos and courses that said instead of paying the bank interest, why not pay yourself back? And this is kind of where I got your concept too. It's like, oh, that kind of makes sense. I've already done it before. And so I took the loan out from my 401k and I dropped it all on the student loan debt, and then now I'm paying myself back the 3.75% interest. But I would like to free up that money. That's retirement money that could be growing, and I can do other things with that, marriage and things like that.
Uh-oh, get married, huh?
Yeah, we're looking at it. Yeah.
Fantastic. Well, we're going to talk about that. Show you how to get all the money back for all that wedding expense you're going to have. All right. So back to the 401k loan. Tell me, so you used it to consolidate all of your student loans. So that's interesting, because there's a lot of people don't even realize that they can take loans from their 401k and pay themselves back with interest. But you figured that out. So you were already actually kind of already on your way to understanding the whole idea of borrowing and then paying yourself back with interest. So that was a huge step up. Not many people understand that.
That's why I was so in tune when I saw your video. I was like, oh, it makes sense.
All right. So how much is the 401k loan?
Right now it's about roughly $31,000.
Okay, so $31,000. All right. And how much per month do you pay to repay that balance?
I'm sorry, 31,700. So right now I pay weekly, but we're gonna do monthly. So monthly I pay about $592 a month. That's with the interest. That's plus that's everything including.
And how much interest do they charge on that?
That's 3.75%.
Okay. But that 3.75%, you actually are paying yourself back with interest right there. Perfect. All right, so our first debt is $31,700. And how long would it take you paying $592 a month to pay that back?
5 years.
Okay. All right. Well, let's talk about the next debt. What's the next one we want to pay off?
Next one is a personal loan debt. I took out a personal loan just because they told me that I need to have some type of loan installment payments. I was going to use that to buy a car. So I took out that loan that was for $27,000, and was at 4.99%. And it's at $509 a month for 60 months.
509, correct?
Yes.
And that's a 5-year loan?
That was a 5-year loan.
Okay. All right. Any more debts?
That is it, man. At this time, I mean, I have a line of credit that I just got approved for and is funded now, but I haven't withdrawn from it. So.
But I mean, you're going to, right? We're going to use that money for something.
I definitely want to use it because it's just sitting there. So if I do use that, it's a $30,000 line of credit.
So just an unsecured line? Is it a home equity line?
can use it, pay it back, use it up for 10 years. And if I were to draw, I think if I were to draw the whole $30,000, it would be about $600 a month over the 10-year span. So at 8.25%.
All right. So we've got a line of credit, a personal loan, and a 401k loan. All right, well, let's total these up. So what do we got? We got 31.7 plus 27. So let's see. So we got 31.7, and that was the 401k. Got a personal loan for 27. You said 27.5? No, 27,000. All right, and then we've got that line of credit for 30,000. So we have a balance that we want to pay off of $88,700. Okay, not terrible, but more than you probably want, correct?
Oh yeah, definitely.
And to pay that off, if I just look at it, we're really looking at about 5 years. But I mean, how long do you want it to take to pay all this debt off?
As little as time as possible.
Okay. So goal, pay off fast. So if we initially have 5 years plus, let's see if we can't beat 5 years once we get into this. Okay, so we've got our debt structure. Now let's talk a little bit about your income. So tell me about, your job, like what is your income? Break it down monthly and yearly.
So my income right now, I would say monthly would be about $6,800.
And then, so 6,800 annually would be about 81,600 bucks.
And that's conservative. I went conservative with the numbers because we have a lot of built-in overtime and premium time. So I kind of went a little below what I would normally get. So it's like, I have a little cushion there. But that's the numbers we want to go with.
I'd much rather you go low than high, because if you go high, then something doesn't happen right. Then all of a sudden, we're changing things. So it's always better to go, with the lower numbers. Okay, so I'll just make a note that these are conservative numbers. All right, now let's talk a little bit about your expenses. So what I want to do, I always like to put expenses in red, and we're going to make them just a little bit bigger than the income, because this is the part that people hate. All right, well, let's walk through what expenses do you have. So we got your debts, we got your income. Now let's talk a little bit about those pesky bills that you got to pay every single month, because one of the most important things that we do is we show people how to build wealth through their own debts and expenses. First off, like a lot of people think to build wealth, they have to go out and they have to work harder, work longer, get their promotions, get their bonuses. That's just what we're taught to do. But one of the things I learned from some of the most successful, wealthiest individuals was the best way to build wealth is to take back the money that you're giving away to everybody else. Already, we've identified in your debts that we're giving away $509 a month, but that's to a personal loan. We're giving away roughly $600 a month to that line of credit that you just got. And $592 a month is essentially going back into your 401k, but that's still cash flow. So now what we really want to focus on is we want to focus on what other money is going out the door every month, and what that out of the money that you're spending, is there any of that we can claw back and add back? Because one of the things that's more fun is you're writing those checks whether you like it or not for all those debts. It'd be way more fun if you got to write those checks to yourself, right?
Yeah, I love that.
Well, let's dive in. So walk me through your expenses.
So right now I just have the basic expenses, the rent, the car insurance, the internet, cell phone, subscriptions, food, gas, things like that. There's other monetary expenses, but these are the basics here. My car's fully paid for. Besides the other debts that I have, I mean, my expenses are pretty much bare minimum.
Okay, so let's go from the top. How much is your rent per month?
It's $817. Car insurance is about $202 a month.
Okay. Internet?
Yes, that's my business internet is about $110. That just went up.
How about those subscriptions? I would assume that's like Netflix, Hulu, and all those things.
Yeah, because I'm completely disconnected with the cable. So the subscriptions are the music for Google. There's the Netflix, Hulu's included with my cell phone, and I think there's one other one that I can't remember.
Okay. So what are all those subscriptions that you got on a monthly basis?
About $33.
33? That's not too bad. All right. How about food? You're on the road a lot, so what are you spending in food per month?
Well, I actually try to cook as much as I can. So $410 is about a good monthly bill for food.
Okay. And then we'll do a miscellaneous for everything else. What would that be?
Like for gas, $120, and then I paid child support at about $468.
You said 468? Okay. But the 468 was already taken out of the other number, correct?
Yes, that's a weekly garnish, so it comes out automatically.
Okay, perfect. So what I'm going to do is I'm just going to put a little star next to that because we've already got that taken out of your income. So miscellaneous, we'll just put down for gas. So our total for expenses would be roughly about $1,899 a month, if that's correct. Is that what you have?
Sounds about right. Yes.
So $1,899. So now if we just total these up and we take the $1,899 a month, so that would mean our annual expense all right, so now let's do this. Let's go in and let's figure out what you look like on paper. So we'll take your income. All right, so if we look at that, you've got income of around $6,800 a month minus your expenses, which are $1,899 a month. So you've got an extra $4,901 per month. Annually, that's $81,600 per year minus the $22,788 in expenses. That means you've got about $58,812 per year in disposable income. So right now, what do you do with that $58,000 per year?
Yeah, I stockpiled it into a checking savings account.
So just like everybody else. I was kind of thinking that, as I asked that, I'm thinking, I wonder what he does with all this extra money per month. Of course. So right now, your current plan, and I love that you're laughing about it, is a checking account.
Yeah. And my checking account looks ridiculous. It's like, what are you going to do with this money?
How much does your checking account pay you in interest?
Oh, God. It's insulting to even say, but 0.02%.
0.02%. Okay, so what would be some other things that would be really important that you'd want your money to do for you?
Rate of return. I mean, return on investment, cash on cash, whether it be, lending to my business or to other businesses, definitely producing some kind of return.
And with this plan design that we're going to do is we're going to have uninterrupted compound interest. There is really no other place that I know of, and I don't know if you know of anywhere else, that you can make deposits, earn that kind of an interest rate, take the money back out, and even if it's in the form of a loan, and still continue to earn uninterrupted compound interest. So that's the thing that really makes this so incredible, is the fact that we can earn that interest. And people don't understand compound interest, which is why Albert Einstein said, those that understand it earn it, which I'm going to show you what we're going to be earning, and those that don't pay it. So we're going to basically change those tides, and we're going to own the bank, which means we're going to basically control that money, and we're going to take advantage of the uninterrupted compound interest. So, all right, let's see what else. We decided on a $50,000 annual deposit, which gives you the flexibility after year one to reduce that down if you wanted. And the way that we've done these plans, most of them, and I'll explain it as I walk through, give you the ability to fluctuate down to as low as 60% less than that, which would be 20 grand. All right, so let's dive into this. So the 4 plans, and we've sent you all these illustrations. So these are the illustrations that we did from Mass Mutual. So they were created, let's see, on 7/1 of 2020, and we did them at 50,000. Now the 50,000, the way we designed these plans, we're putting 50,000 in for 5 years, and then after the 5th year, we're going to do 20,000. So we have to drop it down, and that's primarily due to the MEC guidelines, the IRS MEC 7 pay rules that the insurance companies and the IRS set. So that's how these are designed, and Mass Mutual graciously did 4 different plan designs for us, which was very, very nice of them. So if we get into the numbers, I mean, you're looking at the numbers. I mean, there's 4 different designs. So how do we know which design is going to be the best design for you? It really comes down to our goal. That's really all that matters, is your goal, right? And your goal is to pay off those debts. So whichever one will pay the debts off the most and still have the best returns later is the one we would go with. So if you look at it, we've got the first 2 in the top columns there are the Mass Mutual Legacy 100 plan, okay, which is a whole life insurance policy. The first plan we designed, we did 60% to the LISR. So most people would know this as the paid up additions, but for Mass Mutual, it either goes by ALIR or LISR. So not to get complicated with that stuff, but we're taking 60% of the money and we're putting it into this rider that the insurance company through the whole life allows us to do. And that means that money is going to be available. Then the 40% goes to the base. What is the base? It's basically just a normal off-the-shelf whole life. If you walk down to the life insurance store and you said, I want to buy a whole life, they would give you a whole life policy that was designed 100% base. So how we're doing it, we're doing 60% into the ALIR, which is the paid up additions, and then 40% to the base. That's how we did this. So the first plan is going to be the main plan that we use. It's the plan that a gentleman, I think you read his book, Nelson Nash. Nelson kind of pioneer, it's how he modeled this, and that was his design, was the 60-40. So if you look at it, we broke it down 1 year, 5 year, 10 year, 15, 20, 25, 30. It's a lot of numbers. But if you look at it, compared for the top 2, which is a 60-40 base, okay, and then the other one right next to it is the Legacy 100, which is a 70% to the ALIR, 30% to the base. It would appear that year 1, you have more money with the 70%, which makes sense. We've got 10% more going into that rider. So you got 36, but then year 5, the 70-30 has more. So right off the bat, the Legacy 100 70-30 would solve your problem faster because it would pay off your debt faster since we have more in the first 5 years. And that's really what this is. This is a 5-year, goal to pay that debt off quicker than 5 years. But then the tides turn very quickly as we get down to year 15, if you're looking. Year 15, the 60-40 becomes more efficient and the base all of a sudden starts making more money. So you got 584, 486 in the 15th year versus the 70-30 design, which seemed to be better in the beginning. In the 15th year, you only have 580,000. And then in the 20th year, you have 833. And if you fast forward down to year 30 in the 60-40, I mean, significant difference, right? You got 1.6 million in change versus 1.5 million in change. So we kind of almost have to look at this and say, okay, which one would be best out of these first 2 designs? Well, to solve your problem and your goal would be the Legacy 100 with the 70-30 base, which wouldn't be a bad deal because that would pay all your debts off much quicker, and then we'd still have good growth, but we'd be giving something up later. Now, the one thing I want to remember your debts, and I'm just going to scroll back to it, you're spending $1,701 a month. So if we found a plan that pays those debts off faster, that $1,701 could be recaptured and recycled back into your plan So now we'd have an additional $1,701 that we'd be able to add to that savings. So even though these numbers that we're looking at look like the 70/30s better, both of them are going to have, when we pay your debt off, an additional $1,710 that can go back into the plan as a loan repayment. And then eventually, heck, you could start plan number 2 with the difference. Creating wealth this way is so unique because we actually get to take back the money that we're giving away to everybody else. So those are the first two. Which one of those two do you kind of like? What are you thinking?
Well, they look great, both of them. I see in the long term the number 2. It drops off at the end of the 20-year mark. Like I said, I'm very new to all this, so I'm trying to understand, to see, which one will fit in the beginning and also in the long run. Because this is it's not a quick fix. It's more of an investment vehicle. So in the beginning, I want to hit the debt hard, but in the long run, I still want to be able to have that cash value to keep doing real estate deals. So they look great. Both of them look great. Number 1 looks great is in terms of long term.
Okay. So number 1 beats the long term by quite a bit. So if we were really looking at it, that. Now, we don't have to make a decision as to which one we're doing because we've still got 2 more. So let's look at the next 2 designs. These ones are very good for the short run. They're going to be better. So what we did is here we went Mass Mutual again, put together a plan called the HECV, which stands for High Early Cash Value. That's what HECV stands for. And we designed it with 60% going to the ALIR. Okay, and then we also did 40% to the base, just like the illustration showed. So, and I know that this is kind of what you're looking at, the illustration. So we've got, actually, I apologize. This one, we've got the LISA rider, which is going to combine 1-year term insurance. So unlike the other 2 designs, we actually have to add term insurance to this particular design because of those IRS MEC 7 pay rules. So this plan is going to have term insurance on it, which is important because if you think about what we're trying to design here, we're trying to design the most efficient vehicle that's going to move your money because that's really all we're doing. This specially designed and engineered whole life, it's literally just you're going to deposit money in and we're going to move money out. We're going to just move your money like a raging river. So given that, if we have term insurance on there, that's an additional cost. In this one, the cost for that LISA rider is about $13.92 a month, okay, if we did it monthly. So we've got an extra $13 that we have to pay for this term rider. So we have to take that into consideration, but all these numbers that you're looking at already factor out that additional term. I just wanted to point out that these next 2 designs have an added thing that we had to add on, a rider, which is that term rider. So there's an additional cost on these. So if we look at the HECV, HECV stands for High Early Cash Value. High Early Cash Value. That's exactly what we're looking for to pay off debts. So this plan, in the first year, you put 50 in, and you actually can take out $47,045, which is north of 90% in the first year. Significant difference than the other 2. Or the 5th year, we have $260,990. And then as we go down the line, we got $403,000 in change in the 10th year. 15th year is $590,000. 20th year is $839,000. And remember, we put in for the first 10 years $50,000 a year. But then after we did that, we're only putting in the 20 grand. After that point, after the 5th year, we're only doing 20 grand. So, yeah, this is nuts. 25th year, you got 1.1 million, and then in the 30th year, you've got 1.5 million in change. So it's a pretty impressive design. But do you notice one thing when we get to the later years again? So if you look at that compared to that design number 1 that we looked at, the 60/40 legacy, on this one, at the 20th year, we start losing ground to that original plan. So you can see there's a trade-off. We get more high early cash value in the beginning, but we give up something in the end. There's always going to be a trade-off, which is why, when we work with our members and through the Money Multiplier, there's never just one plan that we can use. There's always going to be multiple plan options, and really it comes down to picking the plan option that works best for your goals, not somebody else's. So, it'd be easy if I just had one plan and I just said, hey, this is the plan, take it or leave it, but that's not the way it works. We have to find the plan design that works best for you. So this plan design certainly kicks butt in the short run, meaning this plan more than likely is going to be the plan that's going to pay that debt off the fastest, allow you to take that $1,700 that you're giving away every month and recycle and recapture that money back into the plan the fastest. So from the surface, which we're not, after this, we've got another little surprise to show you and when we really get into it. But from the surface, this one looks to be the winner, winner, chicken dinner, however you want to do it, because in the first 10 years, we are significantly ahead. Actually, first 15 years.
Awesome.
All right, so then the fourth and final plan design that we did with Mass Mutual is the legacy plan again, but we did this, and this has been talked about a lot. I've seen many YouTube videos. I know we had a short conversation about these. There's some people out there that are doing these designs, putting a ton of the money into the ALIR or commonly known as the PUA, the paid up additions rider. They're trying to put as much there and then put as little into the base, because really the whole idea behind that is the base is where the cost for the insurance is. The PUA is how we get money into the insurance company's separate account and earn those returns fast. I look at it like if people were watching this and they really wanted to understand the difference between the PUA, or in this case ALIR, and the base, I always explain it like a rocket. When you got a rocket taking off for space, like SpaceX, they're blasting a rocket off. It's got a whole bunch of booster rockets. The booster rockets do nothing more than get the ship off the ground the fastest way possible. So those boosters, as they get it off, they use up all their fuel very quickly. And then once the ship gets in space, what do? They drop, the boosters drop off, right? Because they're not efficient anymore. They're big, they're clunky, they use a lot of fuel, so they drop those boosters off. So how we got to look at this is the PUA, the ALIR in Mass Mutual's case, is the booster rockets. It's going to get you where you're going really quick. But later on, they become less efficient, where the base becomes the most efficient. You're going to see that become very evident. So if we always can think of the PUA and the ALIR as the boosters and the base as the actual rocket, the efficient portion, then we basically can understand the difference. And the problem, as you saw with the HECV, but we only talked about it a little bit, is we got a little drag. So our rocket on the HECV has like a little rudder on the top that's sticking out a little bit. So it's got drag. So it's not as efficient in the long run because of that drag with the term. But the Legacy 8515, the fourth and final design, that one is all booster rockets. Like, we have a very small base on this. 15% of the money you're putting in is going to base. So in order to do that, to make this plan work, number one, it's a tough plan to design, but we have to put a ton of term insurance. We have to put an awful lot of term insurance on this. Actually, the number for the term insurance was, we got $866,000 and change of term insurance just to make this machine work, because we've got those IRS rules, the Max 7 pay rule. So I want you to be aware that even though this plan in some cases looks like it's the best plan, later that flap on the front is just like a big old drag, because we got to keep the term insurance on. Otherwise, the plan will become fully taxable and will mech. So that's the problem with these plans. I love them. I like this design, but in the long run, it's just think of it as, over time, your cost in the plan will go up with the term insurance. So therefore, later on in life, this plan will become the least efficient. The other big risk with this, and this is never talked about, to do this, the term insurance that we're going to use is going to be partially supported by the dividend. Now, remember we talked about dividends not being guaranteed, so they can fluctuate. And with low interest rates like they are now, that dividend can actually come down more. And if it does, this plan will absolutely be the riskiest plan of all the ones we did, because you've got a lot riding on that dividend. In other words, if dividends went down, you might actually have to deposit more money into the plan than what we set it up at. So the Legacy 8515, because of the term insurance rider that we have to carry on that, can be the least efficient in the long run. But you can see in the short run, the HECV beats it in the first year. It's 47 versus 41. In the fifth year, the HECV beats it again by a lot, 260 versus 245. And then in the 10th year, the HEC fee actually starts to lose out. So the HEC fee loses efficiency in the 10th year to the 85-15, and then the 85-15 kind of takes over. But later, in the later years, what will happen is if you just look at that first design, the original 60-40 beats all of them in the long run. So now we've got 4 plan designs. We've got your goals, which are to pay off debt, and then eventually probably use this for real estate and other things that you're going to use, which we haven't even talked about your future, but solve the problem at hand. So really, now that we've got 4 plans, we can really make a solid decision as to which one's going to solve your goals and your problems, your money problems, which you don't really have many. You're kind of unique, you know. You're a young guy, you're successful, you got a great job, and unlike so many other people, you've actually been a really good saver. Although the savings has been going to the wrong place, but still, not many people are like you. You realize that?
Yeah. It was a whole shift. I mean, I've been through the Dave Ramsey's. I've been through, all the save money and these certain things that you're supposed to be doing. And the main thing I came up with is pay off your debt and stockpile money and try to buy assets. But getting there, it's like, all right, I got this money sitting. I don't have living in New York as well, everything is so expensive. The money's just sitting there. So, when I heard about this, it was like right on time. Like, oh, I got all this money.
There we go. And I love that you mentioned Dave Ramsey, and Dave Ramsey helps a lot of people erase debt. And he does it with the snowball effect, which is essentially a lot of people when they have debt, they think, oh my gosh, I got the highest interest rate. I got to pay the highest interest rate off first. Absolutely not what you need to do. It's the least efficient way to do it in most cases. You start with the smallest balance, you pay the small balance off, you recapture the money you were giving away to the credit card or whatever debt, you put that back on, he does it with the envelopes, right? We do it with a awesome rocket ship here that gives you uninterrupted compound interest. But not trying to poke at Dave Ramsey, but he does say he hates whole life, and I have to kind of do my little pencil poke to him. I love his strategy. He helps millions of people, but he just needs to add one thing to his repertoire and his toolbox, and that's this. Because can you imagine if he did what he does now, but he added this uninterrupted compound interest to the whole mix?
It would be amazing.
Yeah, he should really do a call with me and have me show him how to do that. But that's for another day. But I think what's so unique is in doing this, we've really kind of taken 4 different plan designs, looked at them, take your problems, and we can solve them very easily here. But before we can really solve them, one of the things that we do for all of our members is we walk them through what we call the mapping process. So we don't do that until after your plan's in force. So once we get your plan in force, what we would then do is we would then create your tools. Okay, we have a whole mapping specialist team. The only job is them to work with our clients. We don't charge our clients for this, but we have them take all your debts. So we would take all your debts and your expenses and we would map them out. And we would basically be able to see which one of these plans or what your plan does in the next 2 years and how it solves your problem. Now, one thing I've done for you that we don't do, and we certainly won't unless somebody starts their plan, but I wanted to show you the next steps, is we've done the tools for you. We not only designed the 4 plans, but we went in and we did what's called a Cashflow tool, and we also created the map. And what I learned out of this was unbelievable. I took 4 plans, we cash flowed them, and then we looked at the mapping, and it just blows my mind, absolutely blows my mind what it looked like. But 100%, if we take those, and we're going to look at them in just a moment, if we look at that cash flow and we look at that map, the HEC fee, based on it paying your debts off and based on it recycling and recapturing that $701 that you're giving away on your debts, it by a long shot beats all other 4 designs in the short run. But in the long run, the 60-40 beats it. So now we really kind of got to make a decision. Do we want to play the long game or do we want to play the short game? What is your thought?
That's a good question. Right now, where I'm standing now, I think I want to play the short game just because I want to hit the debt hard and get it out of the way. And like you said, once we get the debt out of the way, kind of recycle the money, do what we got to do, and then eventually start up a new policy.
Well, you're probably going to have to, because there's no way $1,701 after these loans are paid off to this policy, there's no way that money could go into these. We build these plans right under the MEC guidelines. So 50 grand and then 20, that's the most you can ever put in here, like we talked about earlier. And the other thing too, I just want to say this just because there's probably going to be a lot of people that watch this, is it's important to understand that although you're very unique, you've been, through all the programs, the Dave Ramsey's, you've done a great job of paying off or transitioning your debts, and you've also been a great saver and you have a great income. This strategy, the money multiplier that we're talking about here, will work for almost any income. I mean, it might not be 50,000 someone's putting away, it might be 5,000. It might be 10,000 they're putting away a year. It's all just the numbers in the process and how we're doing this. Again, this is the mapping process. This is that additional service that we add. We did it for you because I wanted to kind of show this in this example, but normally this wouldn't be done for anyone until after they've completed their plan, the plan has been issued, and they've funded it. Then we move them over to the mapping specialist and we create these two tools, one of them being the Cashflow tool, which is right here. Okay, this is going to show every single year of your plan based on your deposits. It's going to show you your guaranteed cash value, which is the guaranteed amount with only the 4%, no dividend at all. And then it's going to show you your projected dividend, because remember, dividends aren't guaranteed, and it's going to give you your projected cash flow. So on this, and your projected death benefit. With this one, what we really wanted to do now, and I've kind of got them all broken down and I sent them to you now. The maps and the tools that we do look a little different than what you're looking at, because I just did a summary, but the most important thing here that we really wanted to know is if you scroll down to the bottom two, the top ones are really just what we just did, showing all the values. And we've kind of decided that right up here, that the HECV would be our best tool or our best vehicle and plan designed to use. But now let's just prove it. Okay, so because we can deposit money into these specially designed whole lives and take that money back out as loans, what we actually have to look at is not what most people look at with investments. Most people, when they deposit money in a bank, like you are, they're going to look at the cumulative return. In other words, I put 50 grand in, and how much did my 50 grand make? But here, because we can put 50 grand in and then take, what was it, 40, in the plan we're doing in the first year, $47,045 out. Now what we got to focus on is not a cumulative return, or in other words, a return of how much I put in versus how much I made. Now what we need to look at is cash on cash, just like real estate. You learned this in real estate. If I deposit 50 grand, how much does that 50 grand make this year, 5 years from now, 10 years from now? But every year we want to look at that return. Okay, we want to look at every deposit you make, that year's cash on cash return, because that's all that matters. If we're able to take that money out and use that money to go make more, then we really just want to focus on that. And this gets me really fired up to see these numbers. Can't lie. So if we look at the Legacy 100, okay, the original number one plan, the 60/40. So if you look, the cash flow in the 5th year, and this is what I love. You put 50 grand in 30 days later, or essentially 30 days later, you could take out roughly $53,452. So let me ask you, can you go into your regular bank, your Bank of New York, wherever you bank, walk in, deposit 50 grand. 30 days later, come back and withdraw or take a loan from the bank of your money for $53,452. In other words, the bank gives you $3,452. And then they say, hey, you don't have to pay that loan back. We're gonna take it from your death benefit someday when you graduate. That's only the 5th year. All right, so if we keep going, look, and that's a 6.9% cash on cash return, which is good. Okay, most people get pretty excited about 6.9%, but let's go to year 10. You put in 20,000, you can take out 32,000 that year. That's a 60% cash on cash return. Okay? 15th year, you put in 20,000, you can take out 39,908. That's a 99.5% cash on cash return. When I tell people this and when you show people this, all of a sudden they're just going to say, that looks too good to be true, right? It's not. It's right here in the actual numbers are right there, and these are just right off of the Mass Mutual illustrations. So if we go to the 20th year, you put in 20, you take out 51,000. That's a 156% cash on cash return. 25 is 20. It's a 275%. 20,000 gets you 75,000. 275% cash on cash return. I mean, it's just nuts. And the 30th year, you put in 20, and you can take out $92,000. Now, doesn't that sound like the best plan if you were planning a retirement strategy? Like if you wanted to plan for a supplemental retirement, and in 20 years from now, you can put 20 in and take out 51. And the next year you can put in another 20, or the 25th year you can put in 20 and take out 75,000. I mean, it almost just doesn't even seem real, but this is exactly what Albert Einstein talked about. This is the power of uninterrupted compound interest. No ifs, ands, or buts about it. That shows why he calls it the eighth wonder of the world, the most powerful thing in the financial world. So that's just the original 60-40, which we've kind of dismissed as not being the one that fits your goals. But you can see very clearly, and I did it in green, you can see that that's by far the best long-term plan. But the 70-30, and this surprised me, I'm not going to lie, when I ran the 70-30, it really, outside of having more cash in the first couple of years, it basically was one of the worst plan designs we did. I mean, you put in 50 and you got 52,000. That's less than the original. That's only a 5.8%. And then if you go down to the 30th year, you put in 20, which gets you 80, which, hey, if that's the only plan I showed you, you'd be like, that's pretty awesome. But it's a 301% cash on cash, which doesn't even hold up to a 364% cash on cash. Now we go to the next one right underneath that, which is our Mass Mutual HECV, high early cash value. The winner of your goal, the plan we chose for your goal. I mean, clearly, in the first 5 years, we basically put in 50, and we're now taking out 55,000. Beats everything else. It's a 10.5% cash-on-cash return in year 5. If you go to year 10, you put in 20, you get out 27. Okay, that's a 39% cash-on-cash. But the thing that we can't show here, but we're going to see it on the map, is what we're not showing is that extra money that you're giving away right now for all those debts. We're not showing that money go back in. So the next one that we're going to do is the map, and that's going to show you all that. And then the biggest question I have for you when we get done is, how are you going to spend all this money? That's going to be my biggest question. So the HECV, overall, even if you get down to the 30th year, you put in 20, and you can take out $89,000. That's a 347% cash-on-cash return in the 30th year. So you can see that one, even though it's the best for the short run, it still holds its own pretty well, even in the middle section and in the long run. And then the very last plan design, which was the Mass Mutual Legacy at the 85-10 design, the one that requires the most amount of term insurance. So this is where you're really going to be able to see the impact of the term insurance in the long run. So in the long run, well, year one, you put in, or fifth year, I'm sorry. Your fifth year, you do 50,000, you can take out 52,000. And really, that's the lowest of all of them. That's a 5.6% cash-on-cash return. In the 10th year, you put in 20 and you can pull out 31,608. That doesn't even beat the 70-30. So you can see in those years, the cash flow is just not there. It just doesn't have it. And the reason for that is your rocket has that little rudder. And if I were to go back to my rocket ship, so the 8510's got this like little rudder up here, and that rudder is basically creating drag. So that drag is slowing us down. So I'm actually getting back into my little art here. So you got this drag here. That is the term insurance, and that is definitely, let's just write this down here. Term insurance is a drag. Okay. Coming back down, if we look at the later years, we go down to the 25th year, you put in 20 and you get 70,000. That's 250. Not bad, but definitely not better than the first design and not better than the HECV. And the very last year, the 30th year that we showed, it keeps going until you're graduated, just so you know. You put in 20 and you can pull out 84,000. And again, so you can see the further down we go, the more and more the cash flow is affected, and the more and more your cash-on-cash return is affected because of those term riders that we have to keep on there. Make sense? What questions do you have for me on the cash flow? It's pretty cool to see how much it cash flows every year.
Yeah, I see that. What makes it so different in the 15th year as opposed to with the legacy 10 85 15 and the head?
Mm-hmm.
How come the what's the big change there after the 15th year? Because it's 99%.
So why is it that the 85-15 exceeds the HECV?
Yeah, I see. Yeah, it jumps up so efficient to 99.
Yep. So one of the biggest reasons is at that point, you're still pretty young. So the term insurance cost is not that much. Now, the hack fee, how they do that plan, and I don't really know the specifics, so I got to be careful how I explain it, but the hack fee is designed for the best short-term growth, but it does give some up in the middle. Okay, so how they do it is, I think it's just how they calculate dividends and everything else. But the hack fee is going to give something up in the middle where the legacy plans, because they're just a more consistent growth model, the legacy plans are not. They're just going to be steady Eddie straight through. So because we've got the most going to those rocket boosters, you're seeing the impact of the rocket boosters, which is that ALIR or paid up additions rider. You're seeing the impact right there in the 15th year and even the 16th year. So you see where that does. But then because of the term insurance, which you really can't get rid of because you'll create a MAC, or if dividends change, these plans, the 85-15, you're going to have some potential issues if dividends were to drop. Now, I'm not saying you're not going to have issues in numbers. If dividends drop, the numbers change on all these. But the 85-15 would run into the biggest problems. As a matter of fact, the Nelson Nash, the IBC practitioners, they don't allow their IBC practitioners to use this 85-15 model because they don't believe in it and they think it holds the biggest potential for risk down the line. So that's that. But it's a great observation that you just picked up there that, it does have that higher growth there. It's almost a spike in the 15th year. All right, so now let's do this. Let's look at your map. Let's actually now take everything that we've just done. Look at, I'm excited about it too, but let's take all this data that we just did. Okay, let's look at the numbers. Let's do them month by month, and let's see how fast these plans pay off your debt, and then let's see how much money you have in the future showing that recaptured money going in. So at this point now, what we've done is, your plan's in force, we've funded it, and now what we've done is we've created your tools, which obviously the first tool we did is the cash flow, which we did just a second ago, showing how much money each year, we did it in 5-year blocks, but each year, how much money you would have. That's what the cash flow tools do. So, and it also gives you your cash on cash return. But this is really kind of where the rubber meets the road. This is the point where we actually take exactly what your design is, and we are able to show that incorporating all of your debts. So if we look here, here's your legacy 60-40. So if you look at your legacy 60-40, which was the very first plan design, the one that would work best for long-term but not working for your goals, because remember, everybody's got different goals. If we look at it, what we're going to show here is we're going to show all your debts. You got your private loan, your 401k loan, your line of credit. So we've got all of your debts lined up on here, each one of them being represented with the amount of payments that you're making on them right now. So let me just get a highlighter up here. So in doing that, all these debts, that one, and that one, what we do is we show you using each deposit. So in the first year, we deposit 50 and we take out $28,682. We pay that down on the private loan. The private loan then frees up $509 a month because we pretty much got rid of that. So the private loan's gone. We freed up $509 that you used to give to whoever the maker of that private loan is, whatever bank that is. $509 now doesn't go to them, it now goes to you. And then what we do is we take that $509 and we save that money in a segregated bank account, because what we're going to do is 12 months down the line, so in June of next year, we're going to go into that bank account and we're going to take that amount, which is $6,108. You see that on the screen there? So what we've got is we've got $6,106, which is the combination of all of that recaptured money going in. Plus, in the 13th month, you have the ability to put an additional deposit of $50,000 in. So you can see now what we're doing is now we're actually showing the plan working. We're showing the money multiplier method and the plan design working, but we're also showing the money being recaptured over into a segregated bank account, which is nothing more than a new bank account that you create. You kind of follow that, right?
Yes.
Okay, so this plan, if we just kept doing that, if we took a loan out the first year for the $28,000, take the loan for the 28 and we pay down the private loan, we recapture that money. The second year we put in 50 grand and we take out 33,000. Notice how that number went up. We take out 33,626 and we use that to pay down the 401k loan because we owe 31,000 we owed, but we paid some of it down the first year, okay, because we had some extra. And then we have 29,000, so that 33 loan in month 13. Holy cow! We're not even Chris. We're not even talking about years anymore. We're talking about months. I got to remember that, months. So month number 13 or year number 2, we deposit that in and we pay off that 401k loan, which gives us an additional $1,101. And really nothing changed here. All we're doing is the only change you did is where that money was going first. The $50,000 that used to go into your checking account is now going into this specially designed and engineered whole life, the legacy 60/40 design here. And we're just taking loans out immediately. So you put in $50,000, we immediately take out the $28,000 in the first year after the 30 days is done, and we pay off the private loan, we pay down the 401k, we recapture the money you used to give to the bank, and then the next year, second year, month 13, we deposit another $50,000. We immediately take out $33,626, plus we go into that bank account where that $509 was going, and we took out that $6,108. But now what we're going to do is we're going to apply the loan in green there. So we're going to apply the loan plus the amount in the bank account, and we're going to then pay off the 401k loan. So the 401k loan's done. Now what we got is we've got our recaptured money of $1,101, simply nothing more than the money you used to give to the bank for the private loan and the money you were paying back to your 401k loan. No new money's been created. Then we come down on this one to month number 25, and in month number 25 we deposit $50,000, but we immediately in the first 30 days take out $45,375. Plus, in that segregated bank account that you created, where you were putting the $1,101, we took out $13,000, which is right here. Took out the $13,000 out of the bank account. The combined total is $58,000. We pay off your line of credit. So this plan design, which is the best for long term and not the best for short term, pays all of your debts off in 25 months. So 25 months versus 5 years. And this is using the plan that we did not suggest because this plan didn't solve your goals the fastest. But still, to pay your debts off in 25 months, recycling and recapturing all the money, you're debt-free. Now, the biggest problem is the next year, if you go down and you look at month number 37, you put in 50, and we immediately take out more than what you deposited in the first 30 days. We take out $51,211 plus the money you got in that segregated bank account, which is now $19,344. So month 37, you have $70,555 that you have to figure out where that money's going to go. What would you do with that?
In the 37th month, it's probably a down payment for a house.
Awesome. So now we're going to go into real estate, and then that process just keeps going. So, and all you did here is you just changed one thing, and that's where your money was going first. And by doing that, you now in month 37 have $70,000, and then in month 49 you deposit 50, and now you have 72,000 that you can use in month 49 to go buy another property. You see, that's what I mean. This uninterrupted compound interest doesn't stop. It just keeps going. So 70,000 to one is a down payment on a house. Month 49, that's another house that you're going to probably put a deposit down on. So that's just how the mapping process works. And that's just the first plan. So now what we're going to do is now we're going to kind of go and we're going to look at the plans that we didn't look at right there. So the next plan would be the 70-30 right here. And I'm not going to spend a lot of time, but I just want to show you that the same thing, we ran all the plans, we did the map on all the plans. In this plan, you put in 50, you get 33 out, which pays the private loan down. But the same thing happens here is this plan, we already determined this was the least efficient. It still takes you 25 months to pay off all your debts, which sounds good. But if you look down here later, you've only got 72,000 in the, what month is that? 49th month that you can use. So again, if we compared that to the other one, 72,000 versus the first one, you had 70. So it's almost the same. So 72 and 72, 750. So the first one is still better because you still have more money in the very first one. But let's now go and look at the plan that we actually chose, which is the HECV. So this is pretty impressive. This one really wowed me. So we're not going to do anything but the same exact thing we did on the first one. We're going to deposit 50,000, okay, day one that your plan's issued. But we're immediately in the first 30 days, we're going to take $46,000 out, okay? We're going to take $46,000 out of the plan immediately in the first 30 days, and we're going to take that and we're going to pay down that private loan, and we're going to pay down that 401k. So now, when you paid the 401k down, you only owe $11,000 on that 401k loan, and this is immediately. In the first 30 days, your private loan's gone and your 401k is down from $31,700 down to $11,640. But we take the $509 that you were given to the private loan, and what we do is we recapture that $509 right here, and we recapture that money into that segregated bank account. That's all we're doing there. Then we go down, 13th month. The 13th month, we do the same thing. We put in 50. We immediately, in the first 30 days, take out $49,351. Plus the $509 that you've been putting in that regular bank account, which I know you don't like those regular bank accounts, but it's just what we're showing you do. So we got that $509, which is $6,108. So you got $49,351 of the 50 that you put in, plus $6,108. That means you got $55,000 to use. Your debts, you owe $5,437 on that 401k loan, so we pay that off. And then we go over and we pay all of the line of credit off. So in 13 months, doing nothing different than what you're doing now except for changing one thing, doing a process and walking through and finding the best plan design, 13 months from today, if this is the day when you funded your plan, all of your debts are paid off. Right there and plain as day. And let's see, it's ridiculous, isn't it? You even still have, see, here's the thing. In 13 months, this is where it really is impressive. In 13 months, you paid all your debt off. So you are debt-free in month 13. So I'm just going to write that on here. So you're debt-free. But you still have $28,821 left to go do something with. So you got $21,000 left that we now can go buy some real estate. You can do whatever. You could use that to pay your expenses for the rest of the, would that get you the rest of the year? Pretty close. You could pay all your expenses for the rest of the year and then save even more money. But then comes the next thing. So remember, in the other plans, month 25 is where you were still finishing your debts. In this plan, month 25, it's time to start having some fun. You put 50 in, you take out 41,853. You've got 19,000 in that segregated account, which is, see how fast that happens now? Because remember, now we got all that money recaptured that you used to give away to the 401k loan and to the line of credit. So we all of a sudden now have an extra $1,612 in your cash flow that you used to just give away that's now there, which now you got $61,000 to use in month 25. That'll put a down payment on a house. Month 37, you got $62,000. Because all we're doing, now we're just making the $50,000 and taking out the 43 plus the $19,344. You got another $62,000 to use. And then in the final 49th month, you put in 50, you take out 55, and then right there, you basically have another $19,000 in that checking account, so you got $74,000 to go out and buy more real estate. But the one thing I want you to notice, and I think you do, is even though this plan is the best for your goal, would this be the best plan if you were doing this for more of a long-term strategy?
Well, number one would probably be the best one, right?
Correct.
Yeah, the first plan would have been the best long-term strategy, but this plan is the absolute best plan for your particular goals because we are trying to pay off the debt. So no matter what, no matter how we look at it, if we stick to your goals, this plan works the best. And long-term, this plan will still give you more because now, I think, what did we count? You got, if you were using it for real estate, you got 3 pieces of property that you put deposits down on, 61,000, 62,000, and 74. But I mean, the whole idea here is in 49 months, you now have, like you said, maybe 6 properties if you use that money, but it would have normally taken you 60 months. If you just followed the bank's plan and you did exactly what you're doing today, it would have taken you roughly 6 or 5 years to pay all your debt off. Now we paid your debt off in 13 months. So we paid it all off in 13 months, and now all you're doing is this money from here on down is all being used for your end goal, which is real estate. And what we're actually going to do is we're going to bring you back and do another one of these in probably 6 to 9 months after you kind of got this thing going, and we want to hear really what you're going to do with this money, because now you know your debt's gone in 13 months, which was the only goal you came to us with. We need to figure out where the rest of that's going to go. So we'll really have a lot of fun with that. So although we could kind of stop right there, I want to go one plan deeper because, hey, if we did the work, let's look at it. I want to look at that final 85-15 plan that we were doing, this plan here. Now, this plan actually worked quite well for the short run too, because remember, it gave you a lot of money short run. We put in 50, we take out 40,000. So we put in 50, we take out 40,000, and then we pay off the private loan, and then we pay down the 401k, which basically gives us the same amount, 509, to recapture. So that's year number one. 13 months later, we put in 50 and we take out 41,000 again. We have now 6,108. It's the same thing as before. And now here in month 13, we're able to fully pay all your debt off, just like the other plan. So we have zero debt, but the difference is how much do you have left? 9,100. How much did you have left in the other one? It was like 20,000. So it's a dramatic difference. So yeah, the HEC fee had 23,821 left after paying all your debt off in the 13th month, where the 85-15 only had $9,105 left. Month 25, same thing. Month 20 or 37, same thing. And month 49, same thing. But it would take, even though you have a little bit more than the HEC fee in these 37th and 49th month, 37th month and the 49th month, you have a little more, but you never would have caught up from that difference of 9 and 23,000. So that's the mapping. It really just shows that no matter how you do this, all you're doing is changing one thing, and that one thing is changing everything, because now you're debt-free in 13 months. You now have a vehicle that perpetually will earn uninterrupted compound interest, which you liked. You wanted a cash-on-cash return. You got your cash-on-cash return. And then not only that, all this growth in these plans, not the money you're making outside of the plan, but the money in the plan. So the interest and dividends that you're getting paid by the company, the insurance company, it's all potentially tax-free, and it grows tax-deferred. And we never once during this entire process talked about the death benefit. Never once did we even really go into your death benefit. But if you remember from the cash flows, if something were to ever happen to you and you were to pass away, you've got a really big death benefit that your beneficiaries are going to benefit from. All right, so the HEC fee, should anything ever happen to you, you have over $1 million death benefit to start with. And then, 20 years from now, should anything ever happen to you and you graduate too early, you've got $2.5 million. We didn't even talk about that because really what we were focused on is creating a banking system that was going to solve your goals, and that's what we did. What are your thoughts?
Awesome, man. I'm glad I could see the visual representation of how these plans work. That's amazing. Definitely amazing.
Well, I'm really excited for you. And seeing the numbers on this thing makes me even more excited because I just never, when we first started talking, would I have ever thought we could pay off 5 years worth of debt in 13 months and then give you perpetual money to fulfill the second part, which is real estate and, starting to build that passive income. So down the line, you have financial freedom and you have time freedom to decide, do you want to keep working your regular job or have you created enough passive income to live the life you want?
That's the goal, man. That's the ultimate goal.
All right, man. Well, that's pretty much the wrap.
Yeah. So Chris, man, I want to say thank you. You really showed up here and you really showed me how I can solve my debt problems with the money multiplier system, and actually dove into my personal expenses. Showed me how I can build my passive income and pay off my debt. And I really appreciate you taking the time out to show me how it actually works, man. I'm glad this all came about and I was able to get in touch with it.
Oh, thank you. Well, you know what? I'm just as excited to solve your problems. And it goes back to like that saying Zig Ziglar says. He says, if you help enough people get what they want, you get what you want. So I helped you solve your problems. I'm sure down the line there'll be a time where you can help me solve my problems.
Awesome. Absolutely, man. I look forward to it.
Oh, thank you.